When you look at the US economy, you see a mirage. It looks so real. People are driving around, filling their cars with gas, going to restaurants and buying new things. It makes you think it's real. But when you get closer, you realize that what you saw was simply not what you thought. It wasn't the truth. Well, that's why you came here for the truth, so let me unveil that for you. Today, we're going to look at charts, and more charts. You have reached the chart GPS. Let's get into it right away. US debt to GDP ratio projected to surpass Italy's. Now you know that Italy's is terrible. France, terrible. UK is terrible. The US and Japan, all terrible. And here we have the US going to surpass Italy by 2023. Now all of this is under this estimation of how these economies will projected, to grow. And that's not really ever how it happens. So I'll show you something that's interconnected with that. The Federal Reserve from Atlanta, they like to bring out this information. It's called the GDP Now statistic, something that you need to follow. I do bring it up as often as possible, but if I don't, definitely check up on it every so often. You can go to the frbatlanta.org or just go to a search engine and type in GDP Now. You'll find it. This information up here, so this was back in February, and you will see that it's over 5%. The GDP statistic that they're showing here. It's a forecasting of how the GDP will do. All right? So you heard that in the news. Over 5% growth, the economy is booming and everything is doing well. But as time goes on, you see this number declining. These numbers down here do not get reported. You only hear about this. And that's what happens. Even though a few months have passed since that statistic, you're only ever going to hear about this. And it will try to be out there and remain in memory until hopefully they can get a better statistic to show us, so then they can use that figure. And this is how it works. The information of 5% gets pushed out there in the media. The information at 2% doesn't get out there, and so it doesn't hit the financial news. It doesn't hit the stock market. That's the most important thing. Because that 5% gets reported in the stock market. Oh yes, the jobs numbers are doing well. Everything's doing well. Growth is amazing. And then once it's at 2% or lower, in real terms, you will see this number not being reported anywhere. And that's a big, big mistake for people to actually believe it. Something broke in the economy after 2008. This is something I talk about regularly. I have looked at all of these indicators, literally thousands and thousands of different indicators over the years, and I've been tracking them all throughout this time. I've brought to you several hundred over the years. And how many times have you heard me talk about something broke, particularly after 2008, but also after 2000? Something, I think that was like the initial trigger, and then 2008 is just where everything got destroyed. And you will see that it just simply falls off a cliff, and we are looking at the GDP minus federal debt. It has gone into levels that we've basically haven't seen in decades and decades. Something is really off here, and it's not just this one statistic. I think there was a trigger event that occurred in the year 2000. It wasn't just a tech boom and bust. There was something else going on. And although I've looked at all of these indicators and really tried to figure it all out, there's something else. So I'm just going to stop right there. I don't know enough to detail exactly what the trigger event was. But of course, when I figure it out exactly, I will bring it to you. All you need to know is that there was 2000 and then 2008, and that's where essentially everything has fallen off a cliff. Or in the reverse direction, if we're looking at debt, if we're looking at the expansion of the monetary system and money in circulation, QE money, Total system leverage. This is absolutely absurd. Government, corporate, household, margin, and banks has gone into the levels that we simply have never seen before. No coincidence, though, that the S&P 500 completely correlates to this. And that's the way this has been going now for many, many years. There have been some variances along the way, as you can see at times, but ultimately they're tracking each other. And because of something like margin, where people are essentially gambling on the fact that they're going to take a small amount of money and they're going to bet big and they're going to be able to multiply their earnings. Unfortunately, for a lot of people who take this risk, they go into very negative territory very, very quickly. Big mistake. Because of course, as the market falls down, it doesn't have to fall 50% or 80% for you to basically lose everything or lose most of what you got. It only takes a little bit, depends how much margin you're using and everything. But I noticed that a lot of people today are using margin and are very confident about their practices. They think that they can, for example, short the market, then cover their shorts, or go long and then cover with shorts, and they do all this business of trying to cover up, hoping that they'll be able to time the market. And ultimately, those who try and time the market fail. The so-called greatest investor ever, Warren Buffett, doesn't do those things. He doesn't do market timing. He invests for more of a longer period of time. Of course, he's getting sweetheart deals that you and I cannot get. But at the same time, I do like his strategy that he's not simply buying things today and selling tomorrow. He wants to be able to hold on to them and watch them grow, get the dividends, and basically make wise investment choices. There's more to that, of course, but I definitely agree with that model more than like a day trader type of investing. Real S&P 500 index with recessions. Take a look at this compared to the Robert Shiller real price data. Of course, the PE ratios are absurd when you look at them. This is the CAPE, actually, cyclically adjusted PE ratio, compared to the S&P 500. That's the blue line, the S&P, and you could see where it has gone. We don't know where it's going to head ultimately, but the higher it goes, the more out of whack things are becoming. I mean, look at this. Here, since the financial crisis, PE ratios have gone into obscene territories. We've gone all the way back to the dot-com boom and bust, which I think is really ultimately the sign of this exuberance that Alan Greenspan has talked about before. That was really one moment where, to say it's ridiculous is truly an understatement. Real household net worth. I've shown you charts like this before. Ultimately separating the supposed real GDP economy and looking at this as the red line. Household net worth, oftentimes, we can look at this as people's real estate that they have. Maybe they live in a home, they own a condo, house or anything like this. Maybe they have stocks, maybe they have bonds, mutual funds, and things like this that have grown. And oftentimes what we see during bull markets is that the household net worth increases, whether that's from your home or paper assets. This tends to increase. This, of course, contracts to a level that almost goes back to basically to touch each other. And you see that here during the dot-com boom, and it was less present before the 90s. Okay, this is only really existent as of 2000. That's why I say as of 2000 something happened. All right, and then it's going to get more and more intense as time goes on. I think that if you look at this distance here, I think that it will actually contract even further this time around. Now, what does that mean? That means ultimately that the GDP has to increase significantly over the next little while, over the next, let's say, 6 to 12 months, or we have to have a major contraction in stocks, real estate, and so on. One of those things has to happen. I'm not saying that stocks necessarily have to crash. I'm saying for history to be proven right over and over and over and over and over again, as it has, then we will have to have one of the two things. I don't see GDP increasing dramatically, considering they've already fudged the numbers. We know of that. And ultimately what's going to happen, I don't really know, but we could definitely see a lot of QE. That's really the only saving grace here, is the destruction of the currency. A nation of renters. So you see the home ownership rate declining. I mean, this chart goes back to the looks like 2004, where the peak is. And renter-occupied housing as a percentage of the total housing. And looking at this here now, obviously people have a big problem. If their house is going to cost $1 million, they're not going to be able to afford it. Now, many people will say, well, I bought my house, it was $150,000. I bought my house $200,000, and so it's not a big deal. But a lot of the places, if you look at where most of the population is in the United States, in Canada, UK, Australia, you look at the housing prices, where the most of the people are living, okay, the big cities, Toronto, Vancouver, New York, San Francisco, London, and so on. These cities here, the houses are more towards that $1 million, not towards the $100,000. Okay, so that's key to remember. I see a lot of comments that don't make a lot of sense, and a lot of things in the financial world that don't make sense either. We're talking about people who are earning household incomes of, let's say, median household income maybe $70,000, and their house cost $1 million. Okay, so there's a great disparity in between the two that is increasing as time goes on. The disparity is becoming so apparent, except to everybody who's buying a house of $1 million when they have a $70,000 household income. It isn't smart, but of course that's simply the way it goes. So more people have to rent. They don't have the down payments. Why? Because they're spending more and more money. Now the rents have increased dramatically. Look at this level over the years. I've shown you before how rents have just increased. Now there are temporary reliefs. Sometimes the government comes in and puts a little bit of a cap on how much they can increase and so on, but ultimately it doesn't really do much because the food is increasing, energy is increasing, and so on. Okay, just a couple more here very quickly. Auto loan 60 plus delinquency index. Look at how this number has increased to the levels not seen since the subprime crisis. Looking at this, in fact, this is the subprime levels, and going back before the subprime crisis, back into the 90s here, not really looking at these ultimately to be a good indicator of what's to come. Inflation is a lagging indicator, and I believe what I had read was that it's a 21-month lag. So it definitely takes a long time for inflation to pick up. And why is that the case? Well, the inflation comes from the central banks, right? So they print all of this money. So they have this big stack of money here. They print it, they put it within the banking system. So the banks here, my excellent drawings, the big banks are sitting on the cash, maybe it's sitting in reserves, maybe it goes out into loans. I mean, that's the hope, right? So it goes out as a loan to an investor, to an individual who's, needs to buy a house, needs to buy cars, whatever it might be. And ultimately, by the time it makes it back around, back into the banking system, maybe back into the central bank's reserves or whatever it might be, however it comes about, this all takes time. So that inflation, for its way to make it in the system, to buy things, to get things happening, it takes a long time. And in this case here, this chart is showing us a 21-month lag on that inflation. So we have the opportunity here to see much higher inflation. It's already picked up slightly. Even when we look at the fake CPI statistic, we can see that it has grown. So we can expect more of that inflation. I do believe that if you print $16 trillion as they did, you're going to see it come around. Now, where it goes, I've seen it going into equities. I've seen it going into housing. I've seen it going to everywhere, basically, except for precious metals. So ultimately, this is something to look for, as we can actually see the prices of things increasing in real terms while they continue to manipulate all of the different indicators here. Global Hedge Fund Index, just wanted to end off the video with this. You could see that over the year 2018 here, that this has really peaked out and has dropped ever since. As a result, many hedge funds have closed. You have seen these different hedge funds out there basically saying, look, we can't make it anymore. We cannot compete. We cannot do business. We're closing up shop. Everybody, here's your money back. And that's the end of the story. I think that a lot of them are starting to realize what's about to happen here. All the tricks are finished now and you're simply investing in FANG stocks. And if that doesn't work out, they're basically screwed. That's ultimately what has happened here. The market has been narrowed, and the hedge funds realize, I don't want what happened back in 2008 to happen again. I'm just going to give everybody their money back. We've made our profits. Let's call it quits. And that's the end of the story. If you found this video informative, please give me a thumbs up. And of course, if you found the video informative, I know that you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. All you have to do is go to the link in the description. It will take you over to Amazon. Then you'll be able to flip through the pages of these books to see if you like them. Take care.